We're here. We are live. I'm supposed to be showing you that one yet. You're supposed to be meant to looking at this, whatever this is. It's been a minute. I took a couple weeks off. I'm back. Thank y'all for joining us. If you're a SpotGamma member, you know I was back in seat on Monday. And I want to give a shout out to JT and Sherry for both helping me out when I was out. What's up, Christian? Hopefully I'm loud and clear. If I am, comment, thumbs up, whatever you got there will be helpful. Dimecoin, you're in there. All right. And Michelle, thank you very much. All right. So today we're going to talk about OPEX. Look at my hat straight. I'm serious. This is a business, right? So what are we going to cover today? The OPEX effect. Now, if you are a SpotGamma subscriber, you know that we were talking about the bizarre things happening into last week. And we said, look, we have this metric. And if you boil down every bizarre thing happening in this market, the easiest way to navigate this thing is to watch this thing called Core 1M, which is the SIBO correlation index. And if that crosses a specific threshold, then that is kind of the sign that the conditions to crash are in place. Now, we needed a trigger, and I'm not going to sit here and say I had any idea that Friday was going to be the trigger. I thought it might be this week, this OPEX. But what's interesting about this is that even though we had that spasm, things are still weird, right? And it brings up this interesting idea, and we talked about in the morning note a little bit. Tariffs, tokens over tariffs, right? And if the AI stuff is still good, then it washes a lot of stuff away. And then the other interesting thing about this is that there was the whole Trump taco thing, right? And I know that upsets people. So I'm just calling back to the idea that Trump fires a shot across at China. China says, hey, US, you guys are jerks. And we go back and forth. But ultimately, does anything actually really change or stick? And when you think about that and you think about the reaction of Friday, it's kind of like, look, there was an overreaction and people go, this must be serious because the market dropped so much. Whereas I'm trying to say, look, the market dropped so much because of positioning and crowded bizarre skew and derivatives, like not only the options complex but ETFs, right? More ETFs now than single stocks. Like, so you get this oversized outside reaction that's a function of the just poor positioning. And that doesn't necessarily mean that whatever Trump said was as serious as you would think it is based on the market. Another example is that you remember DeepSeek, for example, when DeepSeek came out, NVIDIA dropped 14%. Overreaction when Tesla and Elon started fighting with Trump, right? Stock, I think, was also down something like 14% or more in a day. And you're like, all right, that's a little extreme, right? But it's this excessive positioning. And if you're not watching this positioning and you're not really recognizing when it's super stressed, then you could get run over in these instances, right? And that's the kind of critical thing. And another thing I just want to make clear on this is sort of like this, I don't want to call it epiphany, but it's just something I realized I don't iterate enough. There's not really so much about forecasting here. It's not really saying like, I know this thing's going to happen. Like US GDP is going to go to 8% next year and we're going to go. No idea, right? But everything is an if then statement. If this thing happens, then the odds of this other thing happening increase or decrease, right? If we go below a certain level, if vol goes to this certain level, if positioning gets to this extreme, then you have these if then statements, right? And that's really what everything here is about. Lay out the two scenarios, the good scenario, the bad scenario. When do those two things get triggered? And on that point at the moment, we're still waiting for that kind of like risk back on signal. We crossed 6,700, which is kind of the safe zone again, but we're not closing above there. So it's a little sketchy. But what we're going to do now is we're going to jump in. And before I do that, I just want to bring up one quick thing. We have a great event coming up. I'm going to talk about this in a minute. But if you go here, if you go to spotgamma.com/hidden-forces, we have a bunch of new stuff coming up. We got 5 new tools launching next week. If you're a SpotGamma subscriber, you're going to get a bunch of this. And you're going to see a bunch of this. But if you're new around these parts, we're about to sort of significantly up the ante here in terms of what is offered across all SpotGamma membership levels. Is some pretty amazing stuff. And I'm going to sneak peek one of those here in a couple of minutes. It's a thing that I have been trying to find for a long time, and we just couldn't find it. So we built it. That's how much of how things around here often work. So enough of that. Let's go break down on the market. There's a sneak preview of what I'm about to talk about. And let's just talk about positioning writ large, right? So this is our trace system. And what Trace is doing is, many of you obviously know at this point, but what Trace is doing is it's showing us exactly how the S&P is positioned, right? From the dealer's perspective. And so what you'll note today across the strike range here is the map is a giant bright red. Now, what does that mean? That means that there's a lot of negative gamma positioning in the S&P 500. What does that mean? Things aren't terribly stable when I look at them. The stability gauge here is at 71%. This is kind of this is almost like a percentile, right? 71%, not quite as stable as 99%. And when you look here and you just see red negative gamma across the board and you see hero feeding down, there's not an obvious great support zone here. There's a little bit at 6,600. That's why there's a little shade of blue right here. But this map is overall red everywhere, right? And so what that tells me is price is going to remain fluid. And if we talk about the seek and destroy algo, which is something we do in zero DTE positioning, that started to come back a little bit this morning. But what is fascinating about that is all that positioning kind of shifted. So let me give you an idea of what I mean by that. Here's 9:30 in the morning, right? Map is bright blue. Everything seems like it's more stable. You can see all of these blue strikes. Now, what happens? Market rips right off of some Besant comments. The seek and destroy algo dictates that we have to hit the 99th percentile strike. So you see here a rip. We tag that strike, right? We move into that level. And then as soon as we hit that level, boom, hero turns, things come for sale. And all of this positive gamma, right? All these bars that were blue, they're all gone, right? So this was like local positive gamma, zero DT, local in time, local in price, and we just kind of fade away, right? And now there's just not a lot of great support out there. So I'm watching this market and I'm thinking to myself, like, where is the bounce spot? There honestly just isn't really like a great one. And I've had to be very comfortable with the idea of saying, like, I don't see a support. I don't really have great advice at this moment, right? Because the positioning just looks pretty terrible. And so doing nothing in terrible positioning makes sense. Is shorting here sensible? Sure, because of negative gamma, because hero continues to go down. You would think at 6,600 we would see some positioning. Again, I'm looking at all expiration flow right now. So I would look for a possible bounce there. But when you zoom out even farther, until you get to 6,400, there's not really much material positive gamma right now, which is what we would say would be support. Now, if we look at this another way, I oftentimes looking at the old school GEX charts. Our GEX chart is the only one I know of that shows the latest in dealer positioning. So this is updated every morning. We show this across all U.S. listed instruments, all U.S. listed stocks and indices. And this shows you the Gex curve, right? And so we all are familiar here with the idea of positive gamma, right? Positive gamma in a curve is where you would expect sort of vol to to come in. And what's fascinating about this is if you see here all the way up at 6,700, there is a bit of positive gamma in terms of 1.7 billion, but this number is negative as we just go lower, right? There's just no, and that's due to these big negative strikes at 6,500, et cetera. So when would selling exhaust? Well, in an interesting perspective here, it's not until like 6,300. So if there's an AI issue, meaning maybe TSM, which I think reports tomorrow morning, if they miss, for example, that's a problem, right? AI narrative kind of bubble bursts in any kind of way, then we start to lose a lot of positioning that's keeping the market up. And you just don't really exhaust downside flows until kind of 6,400, let's call it. Really, that's where this curve flattens out. The second thing is the dynamic of 1 or 0 DT expiration. So if we remove total gamma, we just take out next expiration, which is today. Look at how much deterioration there is in positive gamma. There just is no positive gamma. So the people that come in and they mess around today, right? I'm going to trade some 0 DTs and they disappear again. They're offering short-term stability, but when they close up their positions, guess what? It's like trapdoor, right? Trapdoor is pulled out and then volatility kind of rears its ugly head again. So this is the transient nature of positioning. And because positioning is so transient, you really can't rely on things when you're saying, I'm going to hold a longer term position right now, right? We want to see positioning be stable in order to initiate longer term positions. And if that's a little bit new to you, that idea, and every founder's note, we have this idea or this thing called a pivot. And the pivot simply is we think things are stable. We think vol is going to remain relatively contained. And that is an area where we're comfortable holding longer term positions. So we'll own spiders and we'll just maintain holding spiders. Maybe we'll sell some calls. Maybe we'll just let it run. Whatever it is, we're comfortable with the market stability there. And when markets are stable, they tend to just grind higher, right? When you move below that pivot level, that's where the positioning is a negative gamma positioning. Vol can spike. Things are, again, transient. I keep using that word. And that's why this pivot level is so critical. And there's a lot of thought that goes into that pivot level. But ultimately, all we're trying to do here is distill everything down, right? Put everything down into a single metric, right? Like Core 1M, for example. And if you're confused about the Core 1M thing, I just want to touch on this. If we go back to Thursday morning, the 7th, you see Taco Burrito over there saying I got sound issues. You all good? Everyone can hear me? I'm going to say yes until you say otherwise. So what happened on the 7th? On the 7th, we wrote this. Core 1M crossed below 8, which is our trigger to add end of October downside hedges. This means we'll look to add a tranche of puts and put spreads and possibly risk reversals, selling call to buy put. And if the SPX should cross the 6,700 level, we will be more aggressive in adding downside plays. Now, we had been laying out in the founder's notes all of the data we were looking at that led us to this conclusion. It's not like a technical analyst where we just go, here's the metric and this is the one thing and this is a line that's crossed on a chart. There's a lot of things that we can boil down or simplify into looking at this metric, right? And so here's how we broke all this down, and we noted the 6,700 was the trigger, right? So we added some puts because correlation crossed this metric, which I'll show you in a second, often suggests market risk, but we wanted to just add some puts, right? A sleeve of puts, because correlation can get low and stay low, right? We want to have that positioning shift to something that's in our favor directionally, which is why 6,700 was and still is pretty critical. So we broke all this down here, but this is the Core 1M chart. And if I bring this up over here on the SIBO, and this is not an intraday thing I'm watching, or if it moves higher intraday, I'm really reacting. I want to see what happens on a daily basis here. And so when we look at this, and I just go to a line chart because it's pretty noisy. What you see here is very clear, right? We crossed this 8 threshold, and this 8 threshold is what we're always looking at as a major risk level, because this is telling us that there's just excess bullishness in the market. That's all this ultimately is telling us. It's saying that single stock vols are extremely high relative to the S&P. The equity market is just out of sorts. It's out of whack. And to give you an idea of the driver that is behind this, if we go and we look at the OPEX effect, I'm going to be putting this out with Jack. So the charts are a little noisy, but we'll have our OPEX video out, and I'll really get into some of those, some of that data. And we talked about this in the Founders Zone. This is call volume, U.S. options call volume. Now, it turns out that super spike was on the 10th. Same here with the puts, right? But the overall trend of rapidly increasing call volume into the October was extremely intact, and that was not something that was happening in puts. Now, October 10th was just a blowout options volume day, but you can see that trend higher, right? So what's happening is people are really frothing at the mouth, going to rush into these calls, right? AMD is up 40% in a day. Intel's up crazy numbers, like chase. You say the word OpenAI, and it's like, well, where is it? I'll just buy it. What was the price? It doesn't matter. OpenAI, great, I'm buying. So that's what happens, right? And then we get the call chasing. And then not only that, what happens, you get incredibly ridiculous call skews. So if we look at our founders notes from Thursday, right, we hammer home here Wednesday morning. That was Wednesday PM. Sorry, I'm looking for the old founders note from the morning. This was a massive dynamic we were talking about. Our compass tool shows you high call implied vols versus lows, or overall, so skew versus high and low implied vols, for example. And what you're seeing here is high call skew percentiles. So when is the 25 delta call more expensive than at the money, right? All these names are on the right side of this specific chart, and they're crowded up towards the high. What does that mean? That means people are tripping over themselves to buy call options. Extremely overbought is what that's saying in options term. That links with correlation, that core MM number being extremely low. So then what happens? 6,700 crosses, Trump lobs one bad tweet. Then all of a sudden, all these really expensive calls have to get pounded. And so if you look at this general chart and you say, okay, well, what does that look like? You fast forward to Monday morning. I think I made a note of this on Monday morning. It was Tuesday morning. The days are all blending together. Okay, here's the updated chart, right? All of a sudden, all the stocks that were crowded in this area of this chart, they dispersed down. That extreme overbought suddenly is still like options are expensive on implied vol terms, but no longer are we like super call heavy, right? So we've greatly reduced that that overbought condition, if you look at like correlation just as a general metric now, you could say, okay, well, if we really zoom back in time, correlation can get a lot higher, like it did in October, but we've more normalized right now, right? Vols are more normal now. Realized vols pop quite a bit. That extreme overbought conditions come down, and so what all this sort of matters to you, or what the signal is here, is we went from extreme overbought to kind of like normal, right? We're not at this situation where you go, hey, vol's really expensive, I got to sell it. Calls are cheap or puts are cheap. Generally speaking, they're not, right? They're all just kind of average. And that's the problem here, right? You could easily have a situation where, like right now, where we're kind of falling apart a little bit and the market's moving down, but there's plenty of room to go, right? Vol can still go much higher from this level with VIX at 20. You get into VIX 30 or 40, go, okay, vol's getting expensive. As an asset class, I'll start to look at selling vol just because it's gotten really, really high, right? And that's ultimately not the case. Saying a lot, I'm going through a lot here. But hopefully this is all kind of making sense. Like, there is just not a great signal here, because in terms of price, we don't have support. We don't have positive gamma. Maybe it's increasing a little bit here around 6,600. You can see the blue on the maps getting a little bit brighter for a bounce. Vol's not particularly cheap or particularly rich. So you just kind of have to like wait for one of these conditions to change. Now, can OPEX be a catalyst for change? Yes. And this week we have Friday OPEX. And then after that, we have VIX expiration on Wednesday. And so I saw one of the questions here is, hey, look, can VIX expiration help to clear out all of what's happening? And I think that's possible, right? And one of the problems here is the term structure, or what you see in the VIX, is quite a bit different from what you're seeing on the S&P fixed strike space. So let's just touch on that for a second. If we go look at S&P volatility, and we just zoom out here a little bit. Now, the VIX, as most of you who are SpotGamma members, of course, know, is anchored to about 30-day expiration options. And so if we look at about 30 days from now, you're looking at around, let's just say 11.7 to 11.21. So here in the fixed strike vol space, you're getting at the money S&P implied vols around 17 to 18. So not only do you have realized vol that's come up to about 12, 13 from extreme lows around 8, now what you have is the Trump Z situation on around October 1st, and then November 1st, and then you have CPI, which isn't printing now until the 24th. So there are these events that can help make vol a little bit sticky. So you have a 17 to 18 implied vol for at the money. If you go down out of the money, you're still in the 17, 18 range versus the VIX that's 21. That's a 3 vol point difference. That's not terribly, stretched. If you look at last week, we were around an 11 to 12% implied vol in the S&P for at the money options, and the VIX was at like 16. So there's a much bigger relative spread right there. And the ultimate sort of point here was there was this odd contango. We talked about this into many subscriber notes last week, where there was this odd contango in the VIX market where you say, okay, short-term implied vols into last week were like at an 8. They're about as low as you can get. But then you have a very elevated VIX, and longer dated implied vols, even just 1 month out, right, were more elevated. So the curve was very steep. This is now normalized. So if you look at term structure now, we're actually in backwardation to sort of flat, right? Whereas before, if you just kind of look this up and you say, okay, what did this look like, a week ago when things were a little bit strange, you can see there was a much bigger relative curve. Here's the 8% implied vols, and then you're getting up into, not super high, but 12 to 13, right? So this curve is really flattened out, and the vol relationship seems to be normalizing a little bit, meaning the longer dated and shorter dated vols are making a little bit more sense. Now, the banks have put out a bunch of different theories on this, ETPs, demand, and the like. What it seems to me is that if you were carrying longer dated options, 1 month, 2 month, 3 month, whether it's VIX options or S&P options, and you're dealing, you're long that stuff, you can cover that carry by just pounding short dated options, and zero DTE volumes increase, etc. And to give you an idea of that, if we look at the size of zero DTE volumes over the last couple of days here, what you see is that we've been very stable, this purple bar, over 60%, right? These last 2-3 months, 60%, all while this vol dynamic was weird. And then what happens as soon as the market gets really wonky, you see that zero DT volume just kind of fades real quick, right? So Monday was very low. We popped up a bit yesterday. The market was fairly stable, and we'll see what's happening in the zero DT space today. But that is kind of the point, right? When the market gets risky, that zero DT volume goes away, that liquidity goes away. And if that whoever's trying to carry this stuff is using that zero DT positioning to help carry. That's a very interesting dynamic, right? It suggests that there could be a lot of trades shifting around in that volatility space. So saying a lot, going real fast. We're going to talk about a couple of new things coming up here, right? Number one, if we just look at the chart of the S&P and we just zoom out a little bit and you say, okay, the vols are normalizing as we just kind of covered, right? Maybe VIX over 20 is a little bit expensive, a little bit rich. VIX, S&P fixed strike vol 17, 18 for 1 month out, given the event that's coming up in 2 weeks here. It feels a little bit rich, not an obvious sell, right? One bad headline from Trump, one bad miss from Taiwan Summit tomorrow, then that vol can easily go much higher. So when you look at this, you say, okay, vols have normalized from overbought to average. But then when you look at what's been happening over or in the equity market space, excuse me, the drawdown is almost hard to see, right? We've only gone down about 150 points. That's 1 to 2%. So again, even in the price space, it hasn't been all that much of a decline. And so when we're looking at the area before saying, hey, can the market go down to 6,400, 6,300? That's where that gamma positioning really starts to level out in the first chart. That's a 5% drawdown, which I think is really something that's really quite possible. And to kind of drive that home, I'm trying to figure out how to get rid of this launch bar down here. Sorry about that. There we go. So to kind of drive this home, if you remember last year in July, we had correlation last cross all-time lows. And so this was that period, right? July, right here. 2024. So July of 2024, right into and around OPEX is when we had this massive market drawdown. And this was totally based on positioning, stretched positioning, just bizarre moves in all the names that we still talk about, right? NVIDIA, et cetera. So here's the all-time low correlation. See that right here? And what you get in here is a 5% to 10% equity drawdown right there, right? 8%. That led to VIX going over 60 or printing over 60 at the start of August, right? It's all of that spasming. So I think the thing that I'm worried about now is saying like, okay, look, is this just sort of round one and we just change these conditions a little bit, or is this something more material? And I think what matters most here is because of is going to be the AI narrative, right? It's the tokens over tariffs, and that's why the earnings may be pretty important. I don't know that the Trump Z thing matters all that much. I mean, I guess if what comes out of the event is kind of nasty and mean, then okay. But if you start to get some decent earnings number and the AI story remains intact, then overall that means I think that market can remain pretty stable. And just on this point, if you look at the concentration top 10 names in the S&P 500, the top 10 are currently 38%, and this is from Visual Capitalist. This was from actually March, where they mentioned the top 10 being 38%. And that was such a flag at the beginning of the year going into the tariff drama. So this has been a dynamic that's quite weird. As long as this dynamic remains in place, i.e. AI is going to continue to save everybody and we can keep piling in these same stocks, then this could just be a quick, short spurt or spasm, not necessarily, a full-blown kind of seizure, right? Which is what we had back in like July of last year. And then the other time that we saw correlation really hit lows was in February of this past year and right into February OPEX. You can see that right here, right? We crossed these thresholds. This was DeepSeek right here in late January where we crossed the DeepSeek. We were at lows. DeepSeek came out, NVIDIA puked. And then in February, we hit that kind of correlation low again, and then Feb OPEX really opened the door to a larger drawdown. So we do have to be conscious of the fact that the positioning here, right, could lead to a little bit less stability in the single stock space. And the reason I say that is because even though we're down 2%, if you look at the way that things are positioned right now, we're still, from a delta perspective in terms of what's expiring on Friday, still very call weighted. Not only in single stocks, which tends to be call weighted, we still have more calls than puts in terms of deltas in the S&P and other in the other indices. Now, at the real extremes, like in August and September, we had 90% of delta in the call sphere or weighted to calls. Here, obviously, it's 70%. It's quite a bit less, but there's no indication here that people are hedged. They're trying to monetize puts, et cetera, et cetera. So that fuel for a bounce is not really there, right? We've removed overbought conditions, but I don't think that this is a situation where you go into this OPEX saying, hey, this is an opportunity for a big bounce, because we're not really loaded up on puts. Yeah, the vol's a little bit rich, but it's not super rich, and it arguably can't release until the Trump Z meeting or the 24th. So, there is, again, this just very bizarre situation where I think we all, or bulls, really need that single stock space to pick up via AI, right? The Taiwan semi, et cetera. That could be the big catalyst. Yeah, so just take another look at Trace here. One of the things that, just to help people from an intraday perspective as you try to navigate this, is we generally want to buy the dip off of a support level. So you'd kind of look at 6,600. We got to 6,610. Then the other one is Hero starting to move higher? Hero being the purple line. What that tells us is people are buying calls or selling puts. And in so far, we haven't really seen that turn up, right? We haven't seen that move higher. Now, I'm going to show you, I'm not supposed to show you this, but this is one of the new features we have coming out, is our new options calculator. But if you look at Hero here in the S&P 500 space, this is, a mild bounce, right? It's suggesting some support is coming in here because we're no longer going down, meaning people are no longer buying puts and selling calls. What this looks like instead is just a pause in the action is what this is. If you look at the 0DT space, it's not as negative as the longer dated space. This separation is always a concern, meaning we see longer dated expirations get negative, more negative than shorter dated expirations. It means people are buying puts or selling calls for longer dated expirations. That means that the negative delta flows remain intact for something more than today. So that's always an important signal. But there's nothing rosy about this, right? Negative 6 billion. That is quite a high, right? That's a lot of negative pressure. And you look at the single stock space, it's not extremely negative at negative 800 million, but also not good. So there's nobody out here right now saying like, this is a great dip for me to buy. I'm really excited about this intraday swoon. It more seems like taking some off the table or just pausing now that we hit the 6,600 area. So if this was to start to turn up, then I'd look for a market bounce. But so far, really not there. And again, this is not only an intraday perspective, kind of from the longer term perspective. We're just not seeing put sellers come in, vol sellers come in, and that's not giving us any stability in this market flow. So that's always something to really pay attention to. Now, I want to talk about two other things, and these will bleed together. So this is the current compass. A lot of what we do here in trading is looking for the best ideas. Once you have a strategy that you're comfortable with, for me, I really like trading options. I like to buy and sell cheap options, buying those and trying to sell what I think are expensive options. So I'm constantly scanning for those type of opportunities. And that's why I really like the risk reversal tool that you see here, because if you think about all this as a funnel, this is the top of funnel. So on the right here, you have names that have high call implied vols relative to puts. So rich calls in these names. And then on the X and Y axis, you have high IV rank versus low IV rank. So up near the top of this chart, it's quite unusual to have names like this: Oracle, Intel, Reddit, at the top of this chart, because what that's telling us is that implied vol for these names is as high as it's been in the last year. Think about what's happened in the last year. April, the tariff drama of I guess the August spasm was out, but you had DeepSeek. You had just so much going on, again, in April of this year, so many different moves. And then you think, okay, this implied vol now, like an Oracle, is higher than most of those dates, right? That's a pretty crazy statement. And it's because the people are just piling into calls, right? Or the bidding is in calls. So very rich, right? Calls, very unusual. When you look at gold, which is setting historic highs, what's fascinating to me about the gold and silver situation here is people are buying a lot of puts. They are hedging that upside right? As opposed to trying to buy calls to chase. And I think what that is a lot of people just own gold and they want to hedge these big gains. But when you're hedging these big gains, you have to be careful of the fact that you are paying a very hefty price for puts. And I'm going to show you why that matters here in a second and how that actually hits your P&L. So, okay, what are the two things we can take away from here? There's still a lot of bullishness in this market. Implied vols in the single stock space are getting, fairly high, right? As you can see here. But when you look at spiders and Qs, i.e. the macro market, the implied vol is not all that rich and people are not really piled into calls. So what we said in the founders note is like, hey, look, you want to hedge a market move higher here? Call spreads make a lot of sense because implied vol is elevated at a 20% rank, but people are more into puts than calls, right? The market is skewed towards that positioning. So you do a call spread because the spread helps to offset that elevated IV. So we have a couple of earnings coming up. You can see the red E here denotes earnings. So these implied vols are elevated, many of them in front of earnings. But like Oracle is one that is not, right? Earnings are not coming up for Oracle anytime soon. TSM is the big one I think that we're all watching. And you can see that is right here. People are pretty bulled up on this thing at the moment, right? Based on this positioning. And again, we think that the market's really been beat up. This stock is only a fraction off of all-time highs. So whatever we've been talking about the last 2 days in terms of bad things happening, like it has not affected a lot of these names at all. Okay, so I'm going to remind you of the site over here, spotgamma.com/hidden forces. And one of the reasons you want to go here is because you're going to be getting access or being able to try out one of our new tools. And this is it. And I'm super excited about talking about this new tool. So we talked about gold options. This is our brand new calculator. So this is going to be launching in about a week. If you are a SpotGamma member, you will get access to this. I have used every calculator I think you can imagine at this point. I've used not only whatever websites offer calculators, I've also used Interactive Brokers, Bloomberg, Thinkorswim, you name it. And I can never get the right calculations, right? There's always missing an element. And I think this is so critical about this stuff because there's a lot of cool websites out there that are built by tech people. They're not traders. And as traders, we're oftentimes not very good at technology. And so one of the things that we really try to do here at SpotGamma is make sure that the traders are dictating the way that things are being built. And then we have some great engineers that are able to kind of put pen to paper or code to paper or whatever they do, code to binary, whatever it may be. So what is the difference with our calculator? Now, there's some metrics and data points here that when you look at here, you go, okay, I've seen some things like this before, but there's one significant difference. And the significant difference, I think, is the difference between you as a trader being a good trader and you as a trader being a great trader. Right. And it is in these margins that you become a great successful trader and a consistently profitable trader, and you avoid doing bad things as much as you do good things. Right. And those are people who maybe are not learned enough, or they just, they don't pay attention to these details. Right. And the fact that most calculators that don't have these functions tell you that most people, right, aren't aware of these things. And again, this is where the big gains are made or the consistent alpha is generated. So first is I've loaded a few things here. The IV rank, the skew rank, these are all data from our scanner. So when you're looking at your scanner and you're going like, okay, these are elevated in here. Cool. Gold. What's going on in gold? We all know what it is, but let's say I didn't know. So I'm going to go to the options calculator now. And we pop in gold and we say, okay, I'm really interested. My bunker, I don't have a bunker, so don't come to my house with a shovel, but my bunker is full of gold and gold is up a lot. How can I hedge my position? So what are some of the things that we can do here? Number one, you see a typical P&L chart. We've all seen a P&L chart that looks like this, but ours is better. And I'm going to show you why. All right. So let's say that I'm worried about a short-term top in gold and I really want to hedge it out. So gold currently, as we can see on our screen, is right here, 385. So let's just say I'm worried about, a decent move down. And so I'm going to look at buying a 375 put and make sure this is a put. Buy one of those and let's buy something for December expiration because I want to make sure I'm hedged out for the next 2 months. All right, so that's cool. Look, here's my P&L chart. This is basically what I got. and it makes sense. I think I'm going to make a ton of money, or I will generate a nice return here if gold falls apart. This looks great to me, Brent. Well, what's the problem here? The problem is that, as we just told you, the IV rank of gold is 81%. The put skew is 74%. What does that mean? Puts are very expensive right now, even though the stock is up, gold is up. So why does that matter? It's because when you have stock up, vol up, what tends to happen when the asset goes down? Vol comes down, right? Now, there's no guarantees in markets, but this is the type of thing that you need to be aware of when you're trading. If you buy a put in gold right now, you are, based on the last year of data, paying a great premium for that. And we know that put skew is also very expensive, which tells us that on a relative basis, puts are also expensive, right? So puts relative to calls are expensive, and IV rank is also suggesting that things are quite expensive. Okay, so you're sitting here saying, Brent, again, get to the punchline. This is right here the number one reason that this is the best calculator that you can get access to. Again, any SpotGamma member gets access to this, and if you go here, spotgamma.com/hidden-forces, we're going to be covering this in a bunch of webinars next week. You get a chance to try this out, I believe. And this is only one of 5 new things that we are launching. But I think this is the biggest one. All right, let's get to it. This implied vol, when you use the market implied vol in the current market vols, that's what this chart is projecting, right? What does the P&L look like based on current vols? Well, what happens when a stock goes from market up or stock up, vol up, and the stock starts to crash? Or what happens if the market just crashed, S&P, and then starts to rally? What happens to vol? What happens to skew? Stay the same? Does it change? And if it changes, what does that do to your P&L? Does it make your P&L better? Does it make your P&L worse? You don't know. It's going to change it. So what can we do? We hit this little box. It's called IV settings. Not only do you shift implied vol up or down, you can now shift skew, which dramatically changes your P&L or your prospective P&L. So we know that the IV rank for gold, as we said here, is 81. And you can see here the at the money implied vols for the expiration I'm looking at for December. We know that's an elevated implied vol. So I say to myself, we need to drop this down a couple vol points, right? 2-3 vol points. Now, put skew is also very steep. What happens is that flattens when the market comes down because people start to sell their puts as their hedges. Let's just say that something I believe could happen. So look what happens now as I shift my put skew. You're going to see this moves, right? So that steepens it, and this will flatten it out. So now what you're seeing is I'm adjusting the implied vol, not just from implied vol going up or down, a kind of parallel shift. I'm actually manipulating or adjusting skew. And where this becomes extremely critical is in a name like, remember it was Open a few weeks ago, right? Where it was just going crazy. Or whatever flavor of, I was making the joke here about you whisper the name OpenAI, right? AMD goes up 40%. What happens when a stock goes up 40%? The call skew starts to blow out. So you need to be able to shift those skews to understand how your P&L is going to change. So I've adjusted skew, I've adjusted implied vol shift. We give you a whole bunch of different reference points. So you're not just sitting here going like, where am I right now? Well, you know it. Where am I historically? Well, you know it. And then you can make some adjustments. And you can make adjustments based off of what we're telling you up here, the IV rank, the skew rank, all of that sort of stuff. So you get a great idea of how your P&L is going to change. So I save this now, right? And now when I zoom out, I'm getting different lines on my chart. So what you're going to see here is the current P&L is the new P&L of my trade. The purple line, right, is what I would argue, and I just quickly change notes, but that's the P&L that I'm more likely to possibly get if gold reverses and vol comes down and that put skew flattens out, right? Now there's no guarantee, but I'd have to worry about that because I'm buying puts with an IV rank of 81%. So what does that mean? The unadjusted IV, the original IV we were looking at, is that dash line. And so you can see as we move down to 360, the P&L that I thought I would get was $1,000, but the P&L I might get because implied vol came down and put skew flattens out is only $754. Now this is gold. This is a smaller relative implied vol change, but you start to see the difference. And you can start to see how you would say, hey, I bought puts and gold is now at 375, but I'm not yet making money. What is going on? Why? Because implied vol comes down and skew flattens out, and that's going to tell you why your P&L is off. Hopefully that makes sense. So this is the difference, again, between somebody that could be consistently generating profit and someone who is maybe arguably losing, or the worst thing in the world as a trader, as an option trader, is you buy the call, you buy the put, let's say, market goes down, you don't make money. You buy the call, stock goes up, you don't make money. You're like, what the heck, man? And it's because of the fact that you arguably paid too much, right, for those options. So let's look at a couple of other examples. I want to bring up something that's kind of pertinent, and that's Taiwan Semi. I've been talking about that to death. So let's just blow up our earnings chart. Now, our earnings chart, I love it. You actually get a free version. So you go to spotgamma.com. Then there's a free tools, and you can get in here. And we show you every major name expiring along with the implied vol. So tomorrow, we have 1016. We have Taiwan Semi. It's a 4% implied move, right? What I said in the founder's note was I think actually NVIDIA is a really great proxy trade, maybe a punt, based on what we're seeing. And why did I say it? Because look at NVIDIA, right? The calls are pretty cheap on a put to call basis. And then the implied vol rank of 28, that is definitely elevated. And after Taiwan Semi, I would bet that would come in some, right? Because they're not reporting in the next 30 days. But as we all know, Taiwan Semi is a huge producer of material or whatever to NVIDIA, right? So they're linked a little bit. So that could be the interesting proxy. And we mentioned Taiwan Semi just a couple of minutes ago here. We said, okay, like look at this, extremely high implied vol, right? And calls are very rich. So if I really want to nerd out on the volatility space, I think we have the best vol tools out there. And so I can really look at the skew of Taiwan Semi, for example. Are people really piled into puts or calls? What are we seeing? Implied vol overall very elevated, as you can see here, versus the statistics over the last 90 days. You can see that's a very rich call, very rich implied vol surface, right? And the skew, as we just looked at, suggests that these calls, so like a 25 delta call, is pretty rich relative to the at the money. And you can see that here. So we know that these vols are elevated, and we know generally what happens with earnings is implied vol drops, right? So if we go to the term structure, this is one of the things that that you can really help you put things together here, right? Current term structure with earnings coming up. So this Friday's options are at 83% implied vol, very rich. Now, if we use forward implied vol, this is so cool to me because we put forward implied vol when we launched these tools, right? And it's one of those like kind of like ninja indicators, I would say. Like people really in the volatility space get it. And now I'm seeing forward implied vol on Goldman charts and on other people's sites and stuff. And so it's kind of funny. But what we look at here is we would say, okay, after earnings, what's the base case that I should expect for implied vol? Like where should it go? And so we look at a 1 month option. Let's just look at 11/21 expiration. What you see there is implied vol should go from about 47.9, and I would expect it to go around 44, right? 44, 43. So that's about a 3 or 4 point vol drop. If we have a shorter term option in here, like for next week, the 24th, that's about a 10-point vol drop. Okay, so keep those numbers in our head when we're going to look at this. Now, what about NVIDIA? If we go and look at NVIDIA, you can see that the forward implied vol in the short term actually doesn't signal as big of a drop, maybe a 3 vol point. There's actually suggesting here forward implied vol is actually higher, right? Maybe this has to do with some of the Chinese developments. So implied vol for NVIDIA, at least in terms of the forward implied vol forecast, may not drop much after Taiwan Semi. And in fact, these forward implied vol readings suggest that next week's options should actually remain fairly bid based on these events, right? So I go, okay, that's great, because if I buy options into NVIDIA options into Taiwan Semi earnings, that vol may actually hold up okay. That's pretty cool, right? So like that sounds to me like a very interesting proxy. Now, if I look at skew for NVIDIA, it is very elevated, like implied vol, the surface is very elevated. The skew for 12/19 options is quite elevated, as you can see here. But we already have this in terms of a rank. We already know how high it is. And the calls up here, this skew, we've seen times where NVIDIA, the ramp goes up, right? So we know that NVIDIA can get quite crazy in terms of calls getting bid. Calls are not bid relative to puts, as we've already stated based on the scanner readings here, right? So let's just reframe this again. Taiwan Semi, pretty rich implied vols. They should come down after earnings, right? That's always going to be our base case. Calls are quite rich relative to puts. So I probably don't want to own calls in Taiwan Semi because they're expensive. Full stop. NVIDIA, though, calls relative to puts seem expensive, and implied vol suggests that it may not come down that much. So now when I go into the options calculator, and I'm just going to see why this matters. Let's just look at a Taiwan Semi option, and maybe I'm going to short a straddle, for example, or and I want to see why that matters. So what I'm going to do here is I'm just going to add this leg in, and hopefully y'all are learning about this, and this is not just a pure product demo. I really want this to hammer this home. I mean, I think everybody here understands the implied vol drop, but I'm hoping to set up a trade here for everybody and something that's interesting. So the 305s is the at the money. These are the 11-14 options. Let's go with the 10-24 options just to really see how crazy this could get. So there's a put and there's a call for the 305s, and you can see based on current market values, it's about $20 for that position, right? So in this case, I own this, but let's say I think I'm a smart guy, and so I'm going to sell the straddle because earnings is coming up. This is what the basic P&L chart would look like, and you would say to yourself, if the market or if the stock stays within this range, Yahtzee. And if you hold to expiration, that is true. However, the difference between today and next 10 days is a lifetime in terms of everything that could happen in Taiwan Semi and with their options expiration and VIX expiration and Trump tweets and whatever else you got, right? So what you're really doing here is if you're in an earnings trade, you're more than likely playing the contraction and implied vol, right, as opposed to anything else. So if I go into IV settings and I say, look, implied vol is so elevated versus what is normal, that median IV. If you remember, we just said, I think implied vol could come down 10 vol points, right? So that's what this is, 10 vol points. Now you can see my curve in red versus what the median implied vol is and where we are, that solid teal line. So great. Okay, now I can totally see what could happen if implied vol comes down as much as what Ford implied vol forecasts. And then I can come in here and I can see exactly how my P&L is going to shift as a result of that, right? Now, it turns out in this instance, when expiration happens, it doesn't look like my P&L is going to change that much. But what I can do is I can adjust my days to expiration. So what is likely to happen if I just hold this thing for 2 days, for example? So now you see how much the positioning can change, right? So 9 days remaining to expiration. Obviously, if we just hold this, let's just say for 2 days, so into tomorrow, now you start to see the difference, right? The solid line is my P&L because vol is contracting, whereas the dotted line is if implied vol doesn't contract. So if you're short the straddle, you can go, okay, like this is going to be the difference now. It's about a $300, $400 difference. If vol contracts, I'm going to make $400, hopefully, right? Now that covers me from a delta perspective. If the stock goes up or down for about $4. Does that make sense? 1%. If I didn't adjust the P&L and I just used somebody else's calculator out there, I would think I would make about $3, which is obviously not right. So the ability to dynamically shift this is really critical when you're looking at these different positions, right? So hopefully that helps you. I'm not suggesting you naked short or straddle into Taiwan Semi. Please don't do that. This was just for illustration purposes. The trade I do think is kind of interesting here is, let's say Taiwan Semi is let's say Taiwan Semi is a beat, right? And I'm like, I really love this idea of getting long NVIDIA as a cheap trade to see what happens. So let's display. I saved this trade so I can track it. I built this one before, and this is the P&L of an 11-14, so short dated NVIDIA option. And as I said before, it doesn't seem like implied vol is going to change that much as we just looked at, right? We just spent a bunch of time looking at that. So in the IV settings, I don't want to change vol all that much. I'm going to reduce it a little bit because I do think the vol will come down maybe 1 or 2 points, let's say, as a result of Taiwan Semi. But what is more interesting that could happen to me would be that the put skew flattens a little bit, and I think the call skew could get a little bit bid. Now, I can make the call skew extremely bid, or I can kind of wind that back a little bit. But the point is that let's just say that Taiwan Semi is great, and people are like, NVIDIA, man, this is it. Yes. Awesome. So I can jack up that call skew. I can keep the implied vol fairly flat. Good to go. And then I can run this P&L. Now I got to pull back the expiration a little bit because I just want to look at what happens after earnings. So let's just say 1017. Okay, so by the end of this week, I now have a much different P&L perspective than if I just if I didn't adjust skew and I didn't adjust implied vol, right? So you can see here now, if the stock starts to move up into that 190 area, I could potentially make a lot more money if that skew lifts up, because I already know skew is quite cheap based on historical standards, right? And I think the implied vol is pretty stable, so I don't have to reduce that all that much. Then I can have a much better interpretation of what my P&L is set to be. And then if I'm like, where are the big gamma levels? I just hit key levels and I go, oh, there's a ton of gamma at 190. So the idea that the stock moves pretty quickly into that level is something that is super powerful to me and makes a ton of sense. So this is one interesting trade I put together. I would look through. Please don't take this as the levels to look at. I do think Nvidia call spreads are interesting, but you have to adjust to what you think makes sense for you on this specific trade. But I think that the opportunity here for a small amount of risk, if Taiwan semi's hot, market rips, that could really be quite interesting. As could possibly even just QQQ spreads, because as we also showed, the QQQ implied vols are pretty cheap, and the skew is also quite a bit lower than what you would expect given the short-term volatility. So if you like this, if you're super incredibly interested in trying out a calculator and a couple of the other tools, we've made a huge hero upgrade. We have some incredible vol tools coming out. We've added some amazing features to a couple of the things we were just looking at. So all this stuff is really getting a heck of a lot better. Andrew Cortado says, is this essentially what some other people do? No, they don't do this. They don't allow you to move the vols around like we do. And that is the difference. And they also don't give you the statistics. They don't do any of that smart vol stuff. They lie to like monkey with the vol up or down. They don't really let you do. They don't let you go to the next level. And then the other one is you don't get a reference point to what things are now. Is implied vol cheap or rich now? It's oftentimes hard to just see what skew looks like and then adjust that skew. So those are the things, again, that just make your lives, number one, easier, but I think adds in a lot of the alpha that help to make you a successful trader. So go to spotgamma.com/hidden forces. You can sign up for this. If you go to spotgamma.com/OPEX, we got an OPEX spreadsheet for you. I know I didn't cover the OPEX stuff quite as much here today. We did at the jump. And we'll be digging into that a lot more on the OPEX effect on Friday and then the subscriber webinar tomorrow. And then last but not least, let's just take one more quick look at the market here. Big bounce off the 6,600. This is a transient kind of nature of markets through this red zone here. And there's just very little positioning, man. I mean, if you're going to have one takeaway, it's like negative gamma, but just there's not much there, really. It's quite, positioning is quite lax. So, that'll be it for me. I've said a lot. Not much of a hero bounce in here, so that's cool. That's Nvidia, decent bounce there in S&P. We've gone from about -12 up to about 8 billion, so a little bit of dip buying in there. If you're curious what one of the other tools looks like, this is our new hero versus our old hero. I won't say anything else about this one, but this is the big upgrade. All right, sneak peek of something I wasn't supposed to give you, but there it is. Again, spotgamma.com/hidden forces. There's a lot going on in the market. We produce the founders notes every single month to navigate this thing. We got all these new tools coming out. So come on and join us, spotgamma.com/hidden forces. We're going to have a ton of great webinars going through a lot of the things I just went through today, and really trying to be educational and using our new tools to help lift everybody up. So thank y'all very much for joining me today. Any questions, email us info@spotgamma.com. SG is my hero. Thank you, Mike. I appreciate that. Yeah, I think that's going to wrap it up. So questions, info@spotgamma.com, but you can join us here, spotgamma.com/hidden forces. I feel like I've talked at level 30. The calculator, I believe, is going to be available at every subscription. That is the rumor. I stay out of the business end of stuff. Try to keep it clean over here. Only talk markets. But thank you all for joining us again. And I will see subscribers tomorrow. We have our 1 p.m. webinar. If you sign up today, you can join that webinar. If not, join us for Hidden Forces in next week. We're going to be covering all that. There's going to be so much in the markets to cover as well. And so that's it. All right. Thanks, everybody. And we will see you all soon.